Okay, so let's categorize the different assets. And typically, it's not by the type of asset you have, but how the asset was used by the taxpayer. Ordinary assets, the most common example is when a business buys and sells merchandise. We call that, of course, inventory. When you buy something and plan to resell it, you're going to report ordinary income and be taxed at ordinary tax rates. If you sell it at a loss, and we don't plan to do that, but if that happens, then you get to deduct an ordinary loss. And probably for tax purposes, that's the best type of loss you can have, a business ordinary loss, because other types of losses may be limited in terms of how much and when we can use it. Another category of assets, and let me give you another example of an ordinary asset. If you are a service type business and you report your income on the cash basis, meaning that you report it when you collect the money and not at the time you sell your service, you have something called an account receivable. And in the case of a cash basis taxpayer, you haven't reported this receivable as income yet. So if you sell this receivable, it's possible to sell it to a financing company to get your money early instead of waiting for your customer to pay it off. That collection, that sale, is going to be reported as ordinary income. There may be some other types of ordinary assets, like if you're a songwriter, or if you're a painter and you sell your music or your artwork and you're the original composer or artist, that's your business, and you're going to have those items sold reporting ordinary income. Now if you buy a painting, or if you buy a copyright, depending upon how you use that asset, it may or may not be ordinary income. But if you're the original person that created it, selling those items produces ordinary income. Okay, the next classification of assets is a capital asset. And our textbook really says it's defined by what it's not. Here it says, oh, there's 8 exceptions, I believe, on page 5 of our chapter 7 that tells you this is not a capital asset and this is not a capital asset. So everything else is a capital asset. But typically a capital asset is either a personal item, in other words, not business use, or you've bought it and you plan to hold it as an investment. Again, investing and business are not the same things. So the typical investments would be buying stocks or mutual funds or bonds. When you think about investing, these are the typical investment instruments that you would buy and sell. Let me give you some example of personal items. Your personal automobile, your home. You did not buy these items for business purposes, and even though a lot of people think their home is an investment, it's really not held for appreciation purposes. The main primary purpose is to live in. Okay, so, but if let's say you bought raw land and you speculate that it's going to increase in value, well then that's an investment. Again, not a business. You don't have any operations. Okay, so that's capital assets. Now the next category is called business assets, and sometimes we use the term section. This symbol here is called section, just like 2 S's stuck together, 1231, which is a rule in the tax law that describes business assets, assets used for business. And typically they can be either depreciable, like a building, like a business automobile, or a non-depreciable business asset would typically be land on which a business building is located. You also have to have held the asset for more than 1 year. If you hold it for exactly for 1 year, it's not a Section 1231 business asset. Now, if you hold a business property for less than a year, what's going to be, it's going to be classified not as a 1231 asset, but you go back here and treat it as an ordinary asset. Okay, this is business property. Here it says any business asset disposed of within 1 year or less, then we turn it back to that ordinary asset. Question number 1. Inventory sold by a company in an ordinary is an ordinary income asset that appears on Form 4797. Well, 4797 shows the sale of not ordinary assets, but the so-called Section 1231 assets. Now, we learned that back in Chapter 6, when you sell inventory, that's reported on your Schedule, not D, but back on Schedule C. Remember that cost of goods sold calculation? That's part of the inventory costs. So this statement, question number 1, is false. And number 2, a capital asset includes all of the following except, let's go down the list here. A taxpayer's vacation home. Well, you may have, it's not used for business. Now, if you rent it out, it may be considered a business asset, but that's not implied in this term, taxpayer's vacation home. So this would be a capital asset. So that's not what we're looking for. We're looking for the exception here. B, inherited property. Assuming again, whatever you inherit, could be lots of different things, is not used for business, then it is a capital asset. In C, property used in a trade or business. Here is what we're looking for, the exception to a capital asset. Property used in a trade or business is a Section 1231 business asset. And D, stock portfolio, that's an investment, which by definition we've learned in our textbook is a capital asset. So correct answer here, the exception to the capital asset is answer C. Question number 3. An ordinary income asset is any short-term or long-term asset used in a business. Well, short-term business assets we saw were classified as ordinary assets. But if it's long-term business asset, again, that's the Section 1231 asset. So this statement is half true. I guess it's all should be marked false. Yeah? And number 4, a 1221 asset, that's another term for a capital asset, is any asset held for investment. Well, I don't like the way it's phrased, but all investment assets are capital assets. Remember, also personal assets, yeah, are also capital assets. So this is a true statement. Number 5, a 1231, remember that's business asset, is any depreciable, like car or building, or non-depreciable, like land, property used in a trade or business, and not considered as ordinary asset, like inventory. Sounds pretty good. True statement. Okay, let's take a look at more detail regarding ordinary assets. We said inventory that was bought for resale, the normal cost of business, is an ordinary asset taxed at ordinary rates. Accounts receivable, assuming that your cash basis, well, if your accrue basis, again, this is something you would learn in a financial accounting class or accounting 124. We have different accounting classes here at Liebert. 124 and 201, you would learn the accounting for a business, and you would learn accrue method of accounting, reporting income when earned, and you'll see accounts receivable is a common account. But if you're a cash basis taxpayer reporting income only when you collect money, you still have this asset, but if you cash it in early, collect the money by selling the receivable to someone else, the money you collect, the benefit you get is an ordinary income. So The receivable is an ordinary income asset taxed at regular tax rates. Second bullet, sale of business property held for less than 1 year. It should be for 1 year or less. If you hold it exactly 1 year, it's still that other type. You remember that other type was called 1231? Well, if it's held for a year or less, it's ordinary asset, taxed at ordinary tax rates. Third bullet, gains are taxed at the taxpayer's regular rates. Again, ordinary tax rates. But if you have a 1231 or a capital asset, you may be taxed at a better tax rate, which we'll see in a couple slides from now. Here it says losses are fully deductible for the sale of ordinary assets, which is good. You like to deduct because you're going to be saving taxes. But if you have a gain, it would be nice to get a preferential lower tax rates, which doesn't apply to ordinary assets. Question number 1. When an ordinary asset is sold, the gain or loss is subject to ordinary tax rates, not a preferential capital gain rate. So this number 1 is false. Number 2, why is the distinction between ordinary and capital so important? Because ordinary assets get taxed at a higher rate, and you get to deduct ordinary losses immediately, the full amount with no limitation, which is good if you have losses, versus a capital gain which gets taxed at better rates, lower tax rates. And if you have a capital loss, there's some limitations we'll see in terms of how much and when you can deduct capital losses, versus again ordinary losses are deductible immediately, giving you a reduction at the highest tax rates you have. Next, number 3, ordinary gains or losses produced outside the normal course of business relate to the sale of business property held for less than 1 year or the sale of receivables. That's a long statement, but this is a true statement. The general ordinary income you have is the sale of inventory, is the sale of accounts receivable. And what's not usually in the normal course of business is when you sell your delivery truck, when you sell your office building. And if those assets were held for less than a year, then those gains or losses on those sales would be ordinary. If it was held for more than a year, then it would be that Section 1231 situation. Okay, so again, we have ordinary assets, Section 1231 assets, and capital assets. Next, capital assets. The tax treatment depends upon the holding period. Assets must be held for more than 1 year for this better tax treatment. So if you hold it for exactly 1 year, well, that's going to be considered to be short term. What we're looking for is called long-term capital gains. This is the best type of gain to have. You're going to be taxed at lower rates. Here there says an exception. Property received through a gift generally has the same holding period as the transferor. This is the donor who gave the gift. So if you're receiving a gift, you're considered to have held the asset, the gift, as long as the transferor or donor had held it. So if the donor had held it for 5 years, you're considered to have held it for 5 years at the time you receive it. Last bullet mentions property acquired through inheritance is always considered to be held for more than a year, automatically, no matter how long the asset was held by the person who passed away, held it, owned it. The recipient, upon inheriting it, is considered to have held it for more than a year. Now, here's the benefit of having a long-term, more than a year, capital gain, selling a capital asset at a profit. The tax rate that's taxed on the profit could either be zero tax or a small tax of 15%. Okay, that's the general rule. And I'll show you when these two rates apply. But in the case of business property, that's treated as Section 1231, it may be possible to treat part of that gain as long-term. And the tax rates that we treat as long-term capital gain may be subject to a higher rate, 25% rate. Now the lower rates may still apply, the regular lower rates, but this is the maximum rate a gain on the sale of what they call real estate for business use. And we'll talk more about something called Section 1250 gain in a future slide. Now if the capital asset you sold is considered to be something called a collectible, like a coin collection or stamp collection, or even gold, or even antique cars if you're a collector, and you sell those items at a gain, then you may be subject to a maximum tax rate of 28%. Now all of these rates here are less than the maximum ordinary tax rates. Here is a tax rate schedule. Remember, this is the inside front cover of our textbook, specifically for the single filing status. And what you would do is look up your taxable income in this two columns here and go across to find the marginal tax rate that you're subject to. So if you're in these first two brackets here, you can see your tax either at 10% on the first $8,350 of taxable income, or roughly the next looks like 25,000 of income is taxed at 15%. If your total taxable income for the year, including any capital gains, brings you within this taxable income here, your your capital gain tax rate on your long-term capital gains is 0. And that's what we saw over here. Long-term capital gains for taxpayers with taxable income of less than $33,950, that's for single taxpayers, they pay 0 taxes on their long-term capital gains. Also something called qualified dividends, they would pay 0 taxes. Now keep in mind that capital gain is included in the total income, this total taxable income here. Now if the taxpayer's taxable income is more than $33,950 for single filing status, then they're going to be taxed at these higher marginal rates here. But their long-term capital gain and also something called qualified dividends are taxed at 15%. Again, that's what these two rates are talking about here. And if they sold business real estate and it's subject to something called not really subject to something called 1250 recapture, which again we'll talk about later, then the maximum rate that type of gain is subject to is 25%. So if you're a taxpayer that has that type of gain and you fall within this bracket, see this low bracket here, well, you pay this low rates. But if you're up in this high bracket here and you get that section 1250, they call it unrecaptured 1250 gain, then you're going to be paying only that 25% rate. Likewise, in the case of collectibles, if you're in the high bracket up here, you get taxed on this 28% on your collectible long-term gains. Capital assets. Remember how we define that? We have to determine whether you held it short term, that means a year or less, or long term, a year or more. So we figure out the gain and loss on every sale of your capital assets, and we group all the short-term gains together, and you group it with the short-term losses together. Likewise, any long-term gains and long-term losses are grouped together. So let me illustrate this here. We have short long-term capital gains and short-term capital losses. Both of these two are grouped together to get a net short-term capital gain or loss. Likewise, you look at the long-term capital gains and long-term capital losses, and you group those two together. So let's say that you have a net short-term capital gain after grouping it with the losses here, and you have a long-term capital gain after grouping it with this losses here. This is net now. Well, this here is going to be taxed at regular tax rates, the ordinary tax rates. So no really benefit here. But this one gets taxed at the lower rates, that 0 or 15 or possibly that 25 or 28% we had seen for some exceptions. But that's when we have gain short-term and gain long-term. Now let's say that you have combined these together and you have a net short-term capital loss. And here, combining these together, you have a net long-term capital loss. Well, when you have a loss and a loss situation for both, we're going to see eventually when we look at Schedule D, you're going to be able to deduct $3,000 of these losses against other ordinary income you're reporting on your tax return. And any unused losses here, you get to report it back up here next year to offset any gains for next year. Here, if you have any extra losses after deducting that 3,000 meaning the combination of these two losses per year against ordinary income. Any extra long-term loss, you carry it back up here for next year to offset next year's gains. Now what gets a little trickier is if, let's say, you have a gain here but a loss over here, and now you have to combine these two together. If you end up with a gain over this loss, the net short-term capital gain is taxed at ordinary rates. And if you end up with more loss here, eventually when you combine these two, again, 3,000 of this loss can be offset against other income for the year, other ordinary income. Any excess over the 3,000 carried over to next year's losses to offset next year's gains. Or the other combination would be combining this loss short-term with this net long-term together. And if you end up with a loss, again, 3,000 of the loss is deductible. Any excess loss carried over to next year's losses to offset gain. And if you have a net long-term gain, just like we've been talking about, that net long-term capital gain is taxed at either at 0% if you're in the low regular tax rates, or 15% maximum, or possibly that 25% for that unrecaptured Section 1250 gain. Again, we will define that later on, or the 28% if you're subject to the collectible capital gain tax rates. Okay, so there's a lot of netting, and all of these combinations and gains and losses are reported on Schedule D, which we'll see later on. Question number 1. The tax treatment of a capital gain or loss varies depending upon all of the following, except, I don't really like this question, but let's do it anyway. The holding period. Well, that's true. Remember, a year or less is short term. A year or more is long term. Okay, so that's does determine how we treat the capital gain or loss. We're looking for the exception. The basis of an asset sold. Well, maybe not directly, but the bigger the basis, the lower the gain, or the bigger the loss. Okay, although I think this is the answer they're looking for, but I think it has an effect on the amount of the gain or loss to report. In C, the taxpayer's tax bracket, as we saw, let me go back, this one here. If you're in the low tax brackets, your capital gain rate could be 0. If you're in the higher tax brackets, see this 25, 28, all the way up to 35, your long-term capital gains, which is included in these taxable incomes, you take them out and you tax them at 15%. And the rest of the income you have is going to be taxed at these higher rates. So this is good. It to be taxed either at the low 15% or pay no tax at all on those long-term capital gains. So this is important in terms of figuring out the tax on the capital gain or loss. And D, the netting of all those gains and losses like illustrated here, you have to combine gains and losses to eventually get a net gain or loss down here. Depending whether it's short or long term will determine how we treat it for tax purposes. So here it says the answer is B, but I think all of these will apply in terms of calculating the tax on capital gains and losses. Question 2. If property received has the same basis as in the hands of the transferor, that's the person giving up the property, the holding period includes the holding period of the transferor. This is true. The typical example was the inheritance. When the person passes away, the recipient, the beneficiary, sorry, let me think here. No, the typical example was a gift. When a donor, the transferor, gives this gift to the donee, the beneficiary, whatever holding period, the years you have here, also carries over to the donee. Okay, so this is a, and the basis also carries over the same basis. So this is a true statement. Number 3, the holding period of inherited property, which was confusing up here. This is a gift. Yeah? Here, inherited property can be either short-term or long-term. This is a false statement because inherited property is always going to be considered long-term in the hands of the person receiving it, the beneficiary. Okay, so false. Number 4, the following are termed maximum gain tax rates. So the typical long-term capital gain rate is either 0% tax-free if in the lower 2 brackets, or a maximum of 15% if you're in the higher regular tax brackets. Number 5, sales after May 5th, 2003. Of course, we're in that situation now after this date. What are the maximum capital gain rates on the following? In the case of collectible gains, remember collectibles is that things like maybe jewelry or a collection of coins, even gold bullion, antique cars. All of that is taxed at a maximum rate of 28%. Now section 1202 gains, which I haven't really talked about, are special types of stock in small corporations, small businesses, which the government tries to promote. But you know what? Any gains on those type of stock probably would be better reported under these last 2 methods we've been talking about, which I'll describe in a second. Yeah, but anyway, it's going to be subject to a maximum tax rate of 28%. Again, not too applicable nowadays because of these lower rates down over here. The so-called section 1250, or really unrecaptured section 1250, which I'll talk about in the next slideshow, the maximum rate is 25%. And then if your regular tax rates are greater than 25%, then the capital gain tax rate, the long-term capital gain tax rate, is that 15%. And if you're in the lower tax brackets in your regular tax rates, remember the tax rate for long-term capital gains? Probably the best rate you can get. Yeah, 0%, no tax. So here's those same answers again. And this 0 rate was really 5% back before 2009. Okay, so this is the end of part 1. Go ahead and continue on part 2 of our video lecture. Also take a look at the video regarding Form 4797 and Schedule D.